So we're going to do something a little different with today's talk. Rather than use a series of slides with text, we're going to show you everything you need to know about Morien using a series of charts for the simple fact that A, we have 10 minutes, and B, I thought it would be easier to show you who we are rather than tell you. But briefly, for those not familiar, as Gwen said, we are a royalty company. We're bulk commodity focused. We have a very high value royalty, and by high value I mean up to 4%, on a producing metallurgical coal mine in Nova Scotia that's currently ramping up. We also have a royalty on a not yet producing crushed stone or aggregates project, also in Nova Scotia. This is owned by Vulcan Materials. They're an 18 billion market cap producer, North America's largest aggregates producer. They're going to make a development decision in April. They're currently paying us an advanced minimum royalty payment. I think what sets our company apart from others is what we do with our cash flow. We have a quarterly dividend that will go up, commensurate with the ramp up at Donkin, aggressive share buyback program, and although not very capital intensive, most of our time, certainly most of mine, is spent looking for other projects to acquire. And we have no debt. So just briefly, our business model is very simple. Pay out a higher dividend, grow the asset base, buy back stock. On the first point, as Gwen said in her introduction on Morien, we've made it very clear that it's our intent to issue dividends as a high percentage of our free cash flow. So as Donkin mine production goes up, so does your quarterly dividend payment. On the second point, we've already identified the market segment that we want to grow the business with. We're not going to make any acquisitions until Donkin gets a little bit further along. And if you want more detail on this, come see me after the presentation today. And on the third point, the fact is we're trading at a significant discount to our intrinsic value. We have cash, and so why not buy back stock? We've always taken the approach that we are, in fact, the best acquisition that we can make. So let's start by looking at overhead costs. They're down, way down. The simple fact here is that the more cash that we can rein in with this company, the more stock we can buy back, the more dividends that we can issue. Common shares are down. Very active normal course issuer bid program. We don't dilute people's ownership. We've been growing it. We haven't financed this company since 2014. We've been buying in a big way. This is up from 12% last year and up from 5% in 2013. Management in the next 2 years will likely control over 20% of this company. The number of shareholders is down by close to 60%. This is not a metric I don't think I've ever seen another public company show, but it's important to understand with Morien. Our normal course issuer bid has been removing shareholders. Our management and directors have been buying in. It's been doing the same thing. We have a large grouping of high net worth retail investors that have been significantly adding to their positions. What we're left with is a tight group of shareholders who really support the company. And when the Donkin mine turns on, and it will, there's not going to be a lot of loose stock available. And it's this type of tightly held stock that on the heels of good news is exactly what moves the share price up quickly in a public company. A lot of the support for Morien comes with how we run this company. We run it like you would run your own personal balance sheet. Here we're looking at a water flow chart of 2019 cash flow. We started the year with 3.3 million. We brought in 2.3 million in primarily royalties and an asset disposition. We sent out 2.1 million primarily in dividends and our share buyback program, and ended the year in the black with 3.5 million. This is a photo of the Donkin mine. The large building in the background is a 500 ton per hour coal wash plant. It produces a single product coal. It's called a swing coal, meaning it can sell either into the thermal market or into the metallurgical market. If you listen to the mainstream media, you would think that this industry is in terminal decline as renewables increase market share, but the facts do not support that narrative. Global seaborne coal trade is increasing, not going down. It increased 3.4% in 2018, 4.5% in 2020 or 2019, and roughly 5% is the projected growth for 2020. The reason why the global seaborne coal trade continues to grow is that we continually consume more and more energy every year. This planet was roughly 35% urbanized in 1970. Today we're roughly 55% urbanized, and the 8.5 billion people that inhabit this earth in the year 2040 will be roughly 65% urbanized. And we, as a society, simply have not found a way to decouple economic growth and energy consumption. And so the reality, and perhaps the harsh reality for some in the audience, is that all energy types are going to play a critical role in feeding that increased urbanization rate. Natural gas here in blue is going to continue to be consumed in increasing amounts. We're seeing a glut of LNG feed into the market right now from the US and Russia. Renewables are going to continue to increase, perhaps not at the exponential rates that we've seen over the past 2 decades, but certainly a major role to play. Coal, I've highlighted here in red. This is what gets reported. Coal's consumption goes down from 33% to 21%, but only as a percentage of the total energy demand. In absolute terms, the amount of tons that actually make their way into that seaborne coal trade not only remains steady, but actually increases. An important point to make on renewables, despite their phenomenal growth rate that's been exponential, they had almost a 14% CAGR over a 5-year period. What's missing with this data is context. Despite that growth, they now only account for 4% of global energy consumption. And keep in mind that y-axis on the left, as we urbanize the planet, is only going to get bigger and bigger and bigger, effectively putting renewables in a position where they're sprinting just to stand still. Metallurgical coal and thermal coal often get conflated into one commodity type, but they're 2 vastly different commodities feeding 2 entirely different marketplaces of very different values. Met coal feeds into the steel market. There is no viable replacement for metallurgical coal in the manufacturing of steel. In 2019, we don't have the December data yet, but it looks like 1.83 billion tons will have been produced in 2019, a record year. And it's for reasons like this that Wood Mackenzie, who closely tracks the space, predicts that we're going to need to come up with an additional 40 million tons of met coal supply just to meet new demand over the next 5 years alone. So the Donkin mine went into production in 2017. There's 500 million tons of coal resource there, making it one of the largest metallurgical coal mines in North America and giving, not surprisingly, a very long mine life. Donkin, like every other underground coal mine on the planet, spends its initial few years developing the underground infrastructure. And by that I mean driving the main headings, establishing crosscuts, an adequate ventilation system, and laying kilometer and kilometer after conveyor belt, getting the mine ready for the retreat mining phase. And during the retreat mining phase, they're going to either incorporate continuous miners and adopt a retreat mining room and pillar style operation, or they're going to use a longwall miner. A longwall miner is a $100 million piece of equipment. The owner and the operator, the Klein Group, are in the process of exploring this process or the viability of installing a longwall now. We think they'll make that decision very soon. Either way, whether it's with continuous miners or with a longwall, once they get to the retreat mining stage, our royalty jumps from a current rate of around $800,000 a year to $6.5 to $11 million. It's range bound because we're using a range of coal prices. If you value Morien as a very bearish $80 a ton Canadian thermal coal project, then $6.5 million pre-tax is what we'll get. 11 million is if you value us as a metallurgical coal play, and we're using a fairly conservative met coal price of $140 a ton. In terms of what we're going to do with that cash flow, we're going to issue a dividend as a high percentage of our free cash flow. So again, using those 4 coal pricing variables, on the left-hand side, if we generate $6.5 million in royalties, we carve out about $2 million in corporate tax, a little bit of G&A, and we issue dividends as a high percentage of that free cash flow. That equates to roughly 4 to 5 cents per share. 10% yield, implied yield on today's share price. On the upper end, that's 8 to 11 cents. And as Gwen mentioned, she mentioned a $20 to $25 million potential royalty payment. That is true. If they do put in a longwall mine, there is the real possibility here that they go to 5 or 6 million tons a year. And in that event, we'll be getting close to $20 to $25 million a year. Because we're still in the development phase, we're only issuing a penny per share dividend right now. We're just getting started, but yet this still gives Morien the highest yielding dividend stock amongst all the other dividend issuing royalty companies in North America. And just to show you how committed we are to giving cash back to shareholders, we have built in an actual dividend calculator into our website. You can visit it, toggle between different levels of production exchange rates to arrive at what the dividend payout might look like. And regardless of whether you value us as thermal or metallurgical coal, we're trading at a very substantial discount to our net asset value. And I would remind you that we're using a 10% discount here on Donkin. That's very conservative, given that this is a producing asset in North America. And most royalty companies trade at a multiple to the NAV of somewhere between 1 and 2 times. So we think we're quite reasonably priced. So why do you want to own Morien? The Klein Group are advancing this to a highly active, highly productive retreat mining phase where we'll see a significant jump in royalty payments and a re-rating of the stock along with it. Clearly, one of the main reasons is to get access to a very high-yielding quarterly dividend payment. Coal demand isn't going anywhere. We're a long-life company with 30 years on the Donkin mine and 50-plus years on the aggregate project. We are focused on making accretive acquisitions if we can get them at a good price. We're going to continue to buy back stock for as long as we can get it below our intrinsic value. We're buying back stock now. And the annual Donkin royalty could be giving us 1/2 of our current market capitalization in fairly short order. This is a stunning valuation given that most royalty companies, even the pure play ones, trade at a substantial multiple to their annual cash flow. Thank you.